Yes, so good evening, students. Welcome to this session and Happy New Year to all of you. I hope you have revised what we had discussed in the last class because there has been a huge gap between our lectures. So I'm expecting you would have utilized the time revising the syllabus. And in case you have any questions, please feel free to discuss and put it in the chat boxes. And secondly, I will just give you a quick recap where were we before starting the lecture. Yes, so we were we had not yet finished the charitable trust concept, which is what we were discussing in the last class, right? In the last class, what we were doing is we had finished the computation of total income with respect to charitable trust, how the specified income is taxed now under 115 BBI. That is all what we had covered specifically, right? But what was yet left was the registration process of the trust, the denial of exemption under Section 13. So these two small topics were remaining, and that's what we will start with in this particular class. And then we will move on to our next topic, which is the TDS and TCS, right? Yes, good evening, Satish Kumar. So then what we will start with is the TDS, TCS, which is the next chapter that we have. So without wasting any further time, let's quickly get started with the charitable trust itself, and I'll finish that topic. We'll take another 15-20 minutes to finish this topic, and then we'll start with the next topic. So just write down denial of exemption under Section 13. So if you remember that the charitable trust get the exemption under 11 or 1023C, right? Now, if they do not fulfill certain conditions, student, then in that particular case, what will happen? They will be denied the exemptions which are there, isn't it? So therefore, we need to understand that this section 13, which is there, under what conditions it will apply and will deny me the exemption. Number one, income if it is held under the trust for the private religious purposes. For the private religious purposes. So if the income of the trust is applied not for the charitable purpose but for the private religious purposes, then in that particular case, the exemption under Section 11 will be denied. So Section 13 basically operates to say that the exemption will get denied in case these conditions get triggered, or these conditions are basically applicable wherein the trust is not following the rules for which the exemptions were given, right? So these exemptions are not, the general exemptions which are there. These are the conditional based exemptions, which means that the trust has to apply the income for the purpose of the charitable objective, isn't it? So if the income is applied for the private religious purposes, then in that particular case, the exemption will get denied. Secondly, in the case where income from the trust is applied for the purpose of or for the benefit of any particular religious community or caste. Next one is the income is applied for the benefit of the prohibited persons. Or we can write the specified persons also. I'm just writing for your remembrance purpose, but you don't have to say that these are prohibited persons under the in the examination. But It's just for the sake of remembrance that prohibited or the specified person. So, who are these specified persons for which the income cannot be applied? So, these are basically, the list is given under section again 13, that these are prohibited category of person. That if you apply the income or the property of trust for the direct or indirect benefit of these prohibited category of person, then in that particular case, the exemption under 11 will get denied. So, which is basically the author of trust, then any person who has made the substantial contribution to the trust. Substantial contribution meaning what? The contribution more than rupees 50,000. Next is the author, founder, or the person is a HUF, then any member of that HUF. So, relative of the author or the member or trustee, any concern first, trustee of the trust. Any concern in which one to five have the substantial interest. Now, what do we mean by the substantial interest here? Substantial interest means in case the concern is a company, then more than 20% of voting power. In case of any other concern, greater than equal to 20% of the profit share. So, if the income of the trust is applied towards these specified or prohibited person, then in that particular case, the exemption of the trust will get denied. Are we clear? Okay. Next one is, if you remember, there was other implication on this point also. So beyond the exemption getting denied for the income being applied for the prohibited person, there was one more implication that we have already discussed in the earlier class. If anybody can point out, if you have revised, you would remember. What was one more implication with respect to this point? Yes. Can anyone recollect? You have not revised clearly. So if you see here, income applied for the benefit of prohibited person under 13(3) What happens to that? It is considered as the specified income under section 115 BBI. No, Ginny. There is no implication or there is no linkage to filing of return before the due date. So this is considered as specified income under 115 BBI, which is taxed at the rate of 30%, which is taxed at the rate of 30% on the gross basis, isn't it? So therefore, if the income is applied for the benefit of prohibited or specified person, then you will write in the case of or in the hands of trust, number one, exemption under section 11 shall be denied. The first implication is that the exemption will get denied under section 11, right? This will mean that the income, if it is applied for the specified person, this will not be eligible for exemption under 11. Secondly, this will be considered as specified income to be taxed at the rate of 30% on the gross basis under section 115 BBI. Meaning, it will not get any deduction of any expenditure. Number 3 will be, there will also be a penalty. So what it says is, there will also be a penalty which will be applicable in case the income is applied for the specified person under section 271 AAE. In case of the offense committed for the first time. If the offense is committed for the first time, then 100%. 100% of the amount of income so applied. And for the subsequent offense, 200% of the income applied. Are we getting this? So if the income is applied for the benefit of prohibited or specified person, then you have 3 repercussions under the Act. Number 1, the exemption shall be denied under section 11. The specified income will be taxed at the rate of 30% on gross basis under 115 BBI, and the penalty will be applicable under 271 AAE. If the offense is committed for the first time, 100% of income applied, and for the subsequent offense, it will be 200% of the income applied. In the hands of the specified person, what happens when a specified person will get the income from the trust? Any thoughts you have, any section that comes to your mind which can get attracted in the hands of recipient who receives any money or property from the trust? Yes. Yes, Mansha, very good. Yes. Do you remember the specific section, Mansha, by any chance? Yes, very good, Mansha. See, you are already, revising very nicely. And that should boost your confidence. You shouldn't get disheartened by any means. You are already studying. Just, try focusing on your targets, as I already mentioned to you, so that, it becomes easier for you to achieve the regular goals rather than, setting up the big goals. Just achieve the chapter goals that you set for yourself. Yes, very good. So 56 to 10 gets attracted in the hands of the recipient. What was 56 to 10, students? Yes. What was 56 to 10? Receipt of any money or property without any consideration or for inadequate consideration, students. Now we recollect something? Yes. So if you receive any money or property without any consideration or for inadequate consideration, what will happen is, in the hands of the recipient, 56 to 10 taxes that amount. However, in case of the charitable trust, the recipient who receives any sum from a charitable trust which is approved under 1023C or 12AA or 12AB, 56 to 10 is not applicable. Right? 56 to 10, if you recollect, we have done 56 to 10, isn't it? See, what I've done is, if the receipt is from the charitable trust registered under 12A or 12AA or 12AB, or from the trust institutions which are registered under 1023C, 56 to 10 is not applicable. This is what we had written in the income from other source, isn't it? If the amounts are received from the charitable trust, then the 56 to 10 is not applicable. But now, ma'am, you are saying 56 to 10 will be applicable. Yes. If the amounts are received by prohibited persons. Are we clear? So here, in the hands of the recipient, 56 to 10 will be applicable. Are we clear about this point, students? Yes or no? Any questions? Any doubt? Yes? Yes or no? Yes? Okay. Third one, where denial of exemption will happen under 13 is deposit of funds in modes other than under section 11. Okay, one more thing before we go to the third point is, again, let's come back to this point. I want to discuss one more thing. So, as I said, that income, when it is applied for the benefit of prohibited or specified person, these will be repercussions. But section 13 also talks about when it will be deemed that the amounts are utilized for the benefit of these prohibited persons. So 13.2 specifies the instances in which it is deemed that the income or property is utilized for the benefit of these prohibited persons. So, income or property of trust deemed to be applied for prohibited persons. What are those instances? Number one, loan is given if the part of the income or the property is given as a loan without the security, adequate security, or without charging the adequate interest. B, allowing the usage of the property of the trust without the adequate rental. Number C, excess payment for the services rendered to the trust. So if the prohibited person is rendering the services to the trust and are making the excess payment beyond a reasonable sum which is payable to the outsiders, inadequate remuneration for the services rendered. If the trust is then rendering the services to this prohibited person and the other person does not compensate with the adequate remuneration, excess payment for the purchase of property, inadequate consideration for the property sold, diversion of income or property exceeding 1,000. So if the income or the property of the trust is diverted in favor of the prohibited person, which is more than 1,000 rupees, in those cases also it will be considered as the deemed to be applied for the prohibited person. And the last one, investment in the substantial interest concerns, where there is substantial interest. So if the funds of the trust are invested in any concern in which the prohibited person has the substantial interest, then in that particular case, it will be considered that the funds of the trust are applied or are deemed to be applied for the prohibited person. However, where the funds invested in the said concern does not exceed 5% of the capital of that concern, in such a case, the exemption will be denied only in relation to the income which is arising out of the said investment. And for the remaining income, it will not be denied. Are we clear? So just write down over here. In this case, if investment is less than 5%, or you can write like this. where investment in concern exceeds 5%. If investment in concern less than 5%, exemption will be denied only with respect to the income from the investment. The exemption will be allowed for remaining investment. Is this point clear, student? Any question? Any doubt if you have? Yes? Yes or no? Any doubts, any questions that you have? Right? Now, exemption will not be denied if the charitable or religious trust is running an educational or a medical institution or a hospital. And the benefit of these educational institution or hospital has been provided to the specified person. Are we clear? So, whether educational institution or hospital is providing the facility to the specified person, in those cases, the exemption will not be denied. If we are charging the fair amount to them. However, if the facilities are provided to specified person either free of cost or in a concessional rate, then of course we will deem that this is the income of the trust. Are we clear? So just write down. Exemption shall not be denied if the educational rights institution or hospital provide the facilities to the specified unless it is provided free of cost or at concessional rate. If that be the case, in that case, exemption will be denied. Clear? Yes or no, students? I'm not getting any responses from any of the students. Yes or no? Yes? Are these points clear to you, students? I need the answers. Yes or no? Yes, everybody? Okay, perfect. Now moving on to the next point, which is deposit of funds in modes other than 11.5. So if you deposit the funds in the modes other than section 11.5, you will be denied the exemption. You will be denied the exemption under section 30. Are we clear? So if you are not investing in any of the modes which are given under 11.5, we have discussed what are the modes under 11.5, isn't it? So in those cases, you will not get the exemption under 30. You will be denied the exemption. Right? Or if you hold the shares in a company other than which is a public sector company or a government company. So in those cases, you will be denied the exemption. Are we clear? However, just remember this particular point. that this is only applicable if the income is from the charitable activity, right? If the income is pertaining to the business or profession carried on by the trust, right? If the charitable trust is pursuing the advancement of object of general public utility, in that particular case, it is possible that it has a business income also. So this is not applicable to the business income. This is not applicable to the business income, isn't it? This is only applicable with respect to deposit into the mode specified under section 11(5), only with respect to the business, only with respect to the charitable income of the trust, and this is not at all applicable where the funds are representing the profit and gains of business. However, where the trust has the charitable activity plus incidental business income, and it maintains a separate set of books of accounts for the business income, then you are required to deposit the modes into the level. Clear? So just write down. However, if trust has charitable object plus incidental PGBP and maintains separate books of accounts, 11(5) applies. Okay? Yes or no? Are we getting all these points? Okay. Next one, which is applicable in the case of section 13 where the exemption will get denied, is the amount forming part of the corpus, right? Or sorry, anonymous donation forming part of the corpus are not exempt. An anonymous donation in excess of 5% of your total donation or rupees 1 lakh will not be eligible for section 11 exemption. This is what we have already discussed. Okay. So just write down. Anonymous donations. Anonymous donations in excess of, what is the limit? Yes, what is the limit for anonymous donations? What is the limit for anonymous donations?
Ma'am, 5% of total donation or rupees 1 lakh, whichever is higher.
Yes. Secondly, anonymous donations forming part of the corpus of the trust are not considered as exempt. So any donations which form part of the corpus of the trust are otherwise considered as exempt. But anonymous donations forming part of the corpus of the trust are still not considered as exempt. Are we clear? And the next one is trust having the object of general public utility, having the receipts from the business greater than 20% of the total receipts. In that case also you will be denied the exemption, right? Trust having object of general public utility, having receipts from business greater than 20% of the taxes. In that case, you will be denied the exemption under section 30. And the last one is Form 10 is not furnished within the due date of filing the return of income. For what? For what reason you furnish Form 10?
Ma'am, deemed application of income.
Deemed application, and second one?
Accumulation of income.
Correct. So if you are not furnishing the Form 10 within the due date of filing the return of income, then in that particular case, the exemption will get denied. So Form 10 is required to be submitted for the benefit of the accumulation and for deemed application. So the benefit of accumulation would also not be available if you do not file your return of income also. So if the Form 10 and the return of income is not filed within the time limit, then the exemption will be denied. Are we clear? So this leads to the denial of exemption under section 30. Any questions that you have before we move ahead? Yes. Any questions, any doubt that you have? Yes. Okay, perfect. So let's move to the next part of this charitable trust is, so tax on the accreted income. Which is also called as the exit tax. Tax on accreted income or the exit tax that we may call it. Now, what is this exit tax or tax on accreted income? Let us try and understand this in detail. So basically, this is levied under chapter 12EB of the Act. Specifically under section 115TD. Okay. So, what is this tax about? So, what was happening is, let's see, this income which is there of the charitable trust, right? They get the exemption either under 11, 12, 1023C with respect to the income which is derived from the property held under the trust. With a condition attached that the income of the income from the property held under the trust will be applied for the charitable purpose. And where the income we are not able to apply for the charitable purpose and during the year, we are saying that we will accumulate the income, we will invest this accumulated income in the modes prescribed under 11.5 and we will utilize this income within the time that we have given to the assessing officer. If the accumulated income is not applied, then in that particular case, the income is deemed to be the taxable income, or it is also now treated as the specified income taxable under 115BBI. Are we clear? So there is a condition attached to the trust to get the exemption. Isn't it? Now, it is possible that after carrying out the charitable activity for many years, the trust may wind up its activities and dissolve, or they may merge with any other non-charitable institution or convert itself only to a non-charitable organization. Now, over the years, we have given you the exemption with the condition that you are carrying out the activities for the charitable purpose. And now, suddenly, you are utilizing those assets for the non-charitable objective. So, there is no provision in the Income Tax Act which can tax the income which has been exempted earlier and now is remaining in the form of the assets, which are now going to be utilized for non-charitable purpose. So what trust will do is they will carry out the charitable activity for 2-3 years and then convert itself or merge with a non-charitable institution. So in order to ensure that the benefit which has been given by way of exemption to the charitable trust is not misused and the assets that they have created out of this exempt income are not utilized for the non-charitable purposes, this section imposes the additional income tax in the nature of an exit tax when the trust gets converted into a non-charitable organization or merges with a non-charitable organization. Are we clear? So therefore, this 115 TD is introduced to put this additional tax. Are we getting this? So when this additional tax or this tax on the accreted income, what do we mean by accreted income? The accumulated income will be taxable. So just write the instances. $115 TD is applicable when number one, the conversion of the trust charitable trust into non-charitable organization. So basically, when a trust converts itself into any other form which may not be eligible for registration under 12A or 12AB or 1023C. Are we clear? Secondly, the merger of the trust with any other entity not having similar objects and registered under 12A or 1023C. So first one is the conversion, second is the merger of the trust. The third one is in a situation where the trust does not distribute the assets. Non-distribution of the assets To whom? To any other institution or trust which is registered under 1023C or 12AA or 12AB on the dissolution or within the period of 12 months from the month in which the dissolution takes place. So in these cases, the tax will be applicable under section 115TD. So one is the conversion of the trust. Second is the merger of the entity or merger of the trust with an entity not having the similar objects. And third is the dissolution. On the dissolution, the trust does not distribute the assets to any trust registered under 1023C or 12AB or 12AB or 12AA. Are we clear? So what is the third one? You can just write on the top, dissolution. So what is the tax which is applicable? The tax rate which is applicable over here is 34.944%. 34.944% shall be applicable. Are we clear? So if you merge with a entity not having the similar objects, or you convert into any form which is not eligible for the grant of registration, or you do not distribute the assets on the dissolution, this 34.944% will be applicable. Are we clear? If you merge with an entity which has the same objects and which is registered either under 1023C or 12AA, in those cases, exit tax will not be applicable. So just write down, if the trust merges with an entity, not entity, you can write with another trust registered under section 1023C or 12AA or 12AB and having same or similar objects. So this will be the exception. Okay. In that case, 115TD will not be applicable. Yes, this is all including natality, health and education says this is 34.944% is the maximum marginal rate basically. Are we clear? Okay. Now, the first scenario is the conversion of the trust into a non-charitable organization. So 115TD says that the trust shall be considered to be or will be considered to be deemed to be converted into a non-eligible form. So a trust will be considered to be deemed to have been converted into a non-eligible form if the following conditions are met. the registration has been cancelled. Registration of the trust has been cancelled or 1023C has been cancelled. It has undertaken the modification to the objects of the trust. There is modification to the objects of the trust, and after which it has not applied for a fresh registration, or it has applied for the fresh registration, but the application has been rejected. So if you undertake the modification to the objects, you have to apply for the fresh registration. Are we clear? Third one, it has failed to make an application for apply for reapproval or the renewal of the registration where registration is due to expire and the final registration has expired. Okay, so in that particular case, the trust will be deemed to have been converted into a non-charitable organization. So where the registration has been either cancelled or it has undertaken the modification to the objects of the trust and the fresh registration is not applied, or the final registration is not made where the provisional registration is due to expire, or it has not obtained the reapproval or re-registration, or it has not obtained the renewal of the registration. Are we clear?
In case of application of fresh registration, when this firm is need to apply that before conversion or after conversion?
Which form?
Here we say that na conversion of charitable into non-charitable organization, right?
Yeah.
तो यहाँ पे हम डीम्ड इनकम ओनली तब मानेंगे कि अगर वो अप्लाई करता है और वो रिजेक्ट हो जाता है, राइट?
Yeah.
बट मैम अगर वो उसे अप्लाई कब करना है, आफ्टर कन्वर्जन और बिफोर कन्वर्जन, अगर वो डीम इनकम
Before
नहीं
conversion,
माना?
obviously. Otherwise, you will be considered that you have been deemed to be converted into non-eligible form.
Okay.
Here you can just make a minute change. Final registration where provisional registration has expired. Okay. So in these cases, you will be charged the accreted tax. Now, what is the accreted tax on? So as I said, this will be calculated, this tax will be calculated, leave some space and then write on the accreted income, this tax will be charged, which will be the maximum marginal rate, which is how much, as I said, 34.944%. So here they say that the surcharge which is there is going to be applicable to 12% only, and that's the reason why you may feel that मैम आपने जब सिक्योरिटाइजेशन ट्रस्ट और ये सब कॉन्सेप्ट्स करवाए थे तब तो आपने एओपी और इसके टाइम पे एमएमआर कुछ अलग ही बताया था, राइट? सो यू मे से यहाँ पर आप 34.944% कैसे बता रहे, राइट? दिस कुड बी एन ऑब्वियस क्वेश्चन. Because if you remember when we were discussing the assessment of various entities, at that point in time, I had told you MMR as something different, which may be based on whether you are going as per the new scheme, whether you are going as per the old scheme. So the MMR can change, isn't it? So therefore, why here I'm taking 34.944% only? Isn't it? That could be an obvious question. Or don't you have this question? Yes or no? What was the MMR that we had discussed? If you remember, here I had told you in the AOP BOI, I had told you MMR is 42.744% and 39%, right? Old regime or 115 BAC, in whichever you go, because the surcharge rate can be as high as 37%, right? So what makes it here to 34.944? Because here the Act says the surcharge will be 12% only. Here the 37% or 37% or 25% surcharge will not be applicable. Are we clear? So therefore here the maximum marginal rate is how much? 34.944% on my accreted income. Now what is my accreted income? What is the accreted income? So accreted income here will be the FMV of the total assets minus the total liability. This will be my accreted income. Are we clear? So FMV of the total assets minus my total liability. Now, in this FMV of total assets minus total liability, I have to exclude certain points over here. So what is that I have to exclude? So what they say is that the accreted income, which is attributable to any asset, which is acquired out of the agricultural income exempt under section 10, will be ignored. The accreted income, the accreted income attributable to any asset. So under the total assets, I will exclude the asset which is acquired out of the agricultural income which is exempt under section 10. What does that mean? Any idea why they say that you have to exclude the agricultural income?
Ma'am, agriculture income is exempt income.
Yes, because agricultural income is exempt income. That's the reason why they are not saying like this. The reason is that the assets are not acquired out of the charitable activity or the charitable income. The assets are acquired out of the agricultural income. And agricultural income is exempt without any conditions. This tax is basically to prevent the charitable trust from going into the non-charitable objective and then utilizing the assets that it has accumulated out of those income, which were exempt for all these years. And now they are going to use these assets for non-charitable activity. So to prevent that trust from doing that, they are saying that we will charge the accreted income if you convert yourself. Right? Now, the assets which are acquired out of the agricultural income are not pertaining to the charitable income. So therefore, we will exclude those assets. So exclude assets acquired out of agricultural income exempt under section 10. Number 1. Secondly, any asset acquired by the trust which is before getting the registration under 12AA or 12AB or 1023C. So, the asset acquired out of income before the registration under section 12AA or 12AB or 1023C. What could be the logic of this?
Ma'am, in this, they don't get any exemption regarding charitable trust which have.
Correct. So before you get the registration, right, you would have not claimed the exemption under 11 or 1023C. So benefit under 11, 12 or 1023C will be allowed from the date on which the registration is effective. Are we clear? So in that case, you would have not claimed the exemption on that income, and the assets that you are acquiring out of that income obviously will not be also considerable. Yes or no? Is this particular point clear? Yes? Okay. Next is the assets which have been transferred on dissolution to another charitable trust which is registered under 12AA or 12AB or 1023C will also not be considered. So, asset transferred to trust registered under section 12AA, 12AB or 10C. Because if you see, we are saying that the tax on accreted income is applicable only when you do not distribute the assets to any trust which is registered under 2023C or 12A or 12AB. But if you distribute, obviously we will not consider those assets. Are we clear? We will not consider those assets.
Ma'am,
Yes.
Ma'am, there is no that we are transfer it with consideration or without consideration.
No, there's nothing like that as such. All they say is that you should transfer the assets to them, and even in their hand 56 to 10 will be not applicable if they are not the prohibited person. Okay?
Okay, ma'am.
Any other question? Any other doubt? Yes or no? Okay. So, what will happen in this case? These assets will get excluded from my total asset value. Okay, yes or no? So if I purchase the asset from agricultural activity, if I purchase the asset when the trust was not registered, or if I have donated the asset to the trust which is registered under 1023C or 12AA or 12AB, those assets will not be considered, and even the liabilities in relation to those assets will also not be considered. Clear? Now this tax has to be paid within the 14 days from the date of conversion. So what they say is that the tax, this accreted tax or exit tax, has to be paid within 1 second. I think the screen sharing has closed. So this tax has to be paid within 14 days from the date of conversion. So just write down here. To be paid within 14 days. Some Okay, so 14 days from the date of conversion. So what will be the 14 days calculated from? What will be the date of conversion? Where the registration has been cancelled. So 14 days will be from, you can just write here, period of 14 days from. So how the 14 days will be calculated from what period? That is very important, because you will be levied an interest if you do not pay within time. So date when the appeal period expires. Date when the period for appeal expires. If the registration of the trust has been cancelled. Or the 14 days from where, if you have filed an appeal, the order is received by the trust. Or if appeal is filed, 14 days will be from the order date of receipt of the order. Where the trust has modified its objects and not taken a fresh registration, then from the end of the previous year. 14 days from the end of the previous year. So where the trust has modified the objects and not applied for fresh registration, or where it has applied but not received the approval because the application was rejected, in that case, it will be end of the previous year for this. For this, it has applied for the fresh registration, but the application got rejected. In that case, it will be 14 days from again the date when the appeal period expires, or if the appeal is filed, then in that case from the date of receipt of order. So just write it over here. Where the trust has failed to apply for a re-registration or renewal of the existing registration or final registration if the provisional registration is expiring, then in that case 14 days from the end of the previous year. Where the trust has merged with another entity which is not having the similar objects, then 14 days will be from the date of merger. And in case where the trust fails to transfer the assets on the dissolution to another trust which is registered, under 12AA or 12AB or 1023C, then the 14 days will be from date when 12 months expire. Okay. Yes or no? Any questions? Any doubts so far? Yes, students. Any questions? Any doubts with respect to this exit tax? Yes or no? I need answers. Is this clear? At least tell me whether it is clear or not to you. Yes? Clear, everybody? Okay. Now, what is left now is the registration of the trust and the cancellation of the trust. And then, of course, the last small part will be the taxation of the private trust and the political party. Now, with respect to the registration for claiming the exemption, see, the trust can get the exemption only when it gets the approval under 1023C or the registration under 12AB. Failing to register will not help the trust to get the exemption. So if you are not a registered trust, you will not get the exemption unless you are a listed trust under 1023C. So if you remember, under 1023C, I had told you some trusts need not apply for the registrations. Which were those trusts? Any idea? Which were those trusts which need not apply for the registrations? Specific trusts which are listed, educational institutions existing solely for educational purposes and not for profit and wholly or substantially financed by the government. Educational institutions or universities existing solely for education, medical institutions or hospitals where annual receipts are less than 5 crores. These three kind of trust need not apply for the registrations or approvals. See, we have written here you get the unconditional exemption. You do not need to apply for any approvals under 1023C. However, for any other trust, you need to, the primary condition is you need to obtain the approval under 1023C or registration under 12AB. And with respect to the 1023C, post 1st October 2024, no application can be made under 1023C. The trust, if they want to claim the exemption, they have to go under 12AB route only. So the trusts which have already been registered under 1023C will only continue. Other than that, everybody will go under 12AB. Are we clear? Yes or no? Any questions so far? Yes or no, students? I'm not getting any responses. I need responses because I need to know whether you are understanding or not. Fine. So how does the registration process works? Let us understand that. So the registration of the trust is basically in a different manner compared to the normal registrations, where you need to just obtain the PAN. Here you need to make an approval to the Commissioner of Income Tax. Right? So here they need to make the approval, they need to make an application to the Commissioner of Income Tax so that they can get the exemption. So the principal commissioner or the commissioner, only when it is satisfied, will give you the registration. Are we clear? So therefore, first is you need to first apply for the registration. So if the trust has not commenced the activities, if the trust has not commenced the activities, then in that particular case, you need to apply for the registration as the provisional registration. So if you have not commenced the activity, you are yet to commence the activity, then you have to apply first for the provisional registration. Are we getting this particular point? So once you are given the provisional registration, that provisional registration you have to apply. That provisional registration is valid for a period of 3 years. From the assessment year in which the approval is sought. Are we getting that? So, at least 1 month prior to the commencement of the previous year, relevant to which the registration is sought for, you have to apply for the provisional registration. So, just write down. There's some problem with my note. 1 second. Registration of the trust. Okay. So first is if you have not commenced the activities. Before the commencement of the activities, you have to apply at least 1 month prior. So the time limit for application is 1 month prior to the end of the previous year for which you are planning to apply. Are we clear? So at least 1 month prior to the commencement of the previous year. Sorry, not end of previous year, sorry, commencement of the previous year. One month prior to the commencement of the previous year. And what you are going to, what is the time limit? 1 year prior to the end of the, commencement of the previous year. And the commissioner will then pass an order again within 1 month from the month in which the application is received. Now this registration will be valid. So validity of this registration is 3 years. The validity is 3 years from the assessment year, 3 years from the assessment year in which the registration is sought. Okay. So 3 years from the assessment year for which the registration is sought. From that period, this provisional registration will be valid. Are we clear? However, if you have commenced the activities already, if the activities are already commenced, in that case, you need not apply for the provisional registration. So a trust which has already commenced its activity but has not yet availed the exemption under 1023C or 11, then it need not apply for the provisional registration in Form 10A. It can directly apply for the final registration in Form 10AB. Okay, so you will apply the final registration. And this was the provisional registration. Okay, are we clear? Yes, Mansha, we'll have a break in a couple of minutes. I think it's just that my eyes are very sensitive sometimes and it keeps on being watery. Okay. So if you apply for the commencement of the, if there is no commencement of activity, you have to apply for the provisional registration. If the activities are already commenced, then in that particular case, you will apply directly for the final registration. Okay. Now, final registration which is there is to be applied within 6 months of the commencement of activities. So, this is to be applied within 6 months of the commencement of activities. Okay, so this once you apply, then it will be valid for a period of 5 years. So once you get the final registration, students, then in that case, it will be valid for a period of 5 months. Five years from the which assessment year it will be applicable? So 5 years from the assessment year when you made an application. Okay, so from the financial year in which the application is made. From the previous year in which the application is made. So are you getting the difference? If you have not commenced the activities, then you need to apply for the provisional registration. If you have already commenced the activities, then in that case, you have to apply for the final registrations. But when you apply for the final registration, the principal commissioner or the commissioner will make a detailed inquiry into the objects of the trust and will then only grant you the registration. Are we clear? Now, what if the provisional registration that was made is going to expire? The provisional registration that was made is going to expire. Then you have to apply for the final registration. So if you have been granted a provisional registration and that is going to get expired, then at least 6 months prior to the expiry of the provisional registration, you have to apply for the final registration. So, provisional registration is going to expire, right? So 6 months prior to the expiry of provisional registration, you have to apply for the final registration. And the final registration will again be valid for the period of 5 years. So 5 years from the previous year in which trust was provisionally approved. So you will get the exemption from the first year in which the trust was originally approved. It is not that you are now going to get from the new after the 3 years. It is from the retrospective effect. And if the 5-year period is going to expire, then you have to apply for the renewal of the approval. Then, in case of renewal of approval, so this provisional registration is going to expire, so you have to apply for final registration. Okay. Now, renewal of approval, that is expiry of 5 years. Then you have to renew and you have to apply again 6 months prior to the expiry of 5 years. Again, then the registration will be given for the 5 years from the year in which application is made. If you modify the objects, then in that particular case, you have to again apply for the fresh registration. See, if you modify your objects, then you have to apply for the registration again. Are we getting this particular point? So if there is modification of the objects, see, as I said, that if you do not apply for a fresh registration, then what will happen is you will be charged, and what will happen is if you do not apply for the fresh registration, what will happen?
Ma'am, he have to pay tax according to that calculation a certain income.
Yes, then you have to pay the tax on the accreted income. You will be deemed to have converted to a non-charitable institution. Correct? So you have to apply within 30 days from the date of modification. From the year in which application is made. Are we getting this particular point? Yes or no?
Ma'am, one question is that if
Yes.
the commencement activity is started now and within 6 months he is not getting the apply for the registration, then he is never apply for registration?
No, it is not like that. So if the principal commissioner or commissioner is not granting you the registration, then it is deemed to have been given the acceptance. Are we clear? Any other question?
Ma'am,
Yes.
in the validity period, you have mentioned in the first one the provisional registration regarding 3 years from assessment year, and other four you have used the previous year. Whether
Yeah. No, it is also, see, it is basically assessment year or previous year, whatever you can, call for, that is not a problem because it is from the year in which the registration is sought. So
Okay.
either it will apply assessment year wise or previous year wise, howsoever you want to treat it. Doesn't
Okay.
make much of the difference.
Okay.
Any other question? Okay. So if the trusts are already registered under 1023C, they will continue to be governed by 1023C unless their 5-year period is going to expire. After 5 years, when they will apply for the renewal, they have to go under 12A. They have to come under 12A. So once their final registration expires, once their 5-year period expires, now they cannot go back to 1023C because that is over. So then they will have to come under the 12A. Similarly, the trusts which have been provisionally approved under 1023C, and once their 1023C is going to, the provisional approval is going to expire, the final registration will be made under 12A. Okay? Any questions, any doubt? Yes? Fine. So let's take a break of 10 minutes. With this, we have almost completed the trust topic. It's just that I have to just touch upon the cancellation of the trust. Once we complete that, we will just do the taxation of the private trust and the political parties. And with that, we will close the trust topic. Okay, so let's take a 10-minute break. Okay. So students, now we are getting into the last portion of at least the charitable trust, which is the cancellation of the registration. So basically, if you see that if the principal commissioner is not satisfied, right, that if the transactions or the activities of the charitable trust are in such a nature that he feels that the registration needs to be cancelled, he has the power to do that, right? So he can do that if he feels that yes, there are significant violations happening in the trust. Now, what are the kind of violations that he may, feel that requires the cancellation of the registration of the trust? So for that, if you look at the violations which are similar to which results in the denial of the registration. So you can just write down cancellation of the registration of the trust. Right? So what are the conditions where the specified violation can get triggered? Because if the principal commissioner or the commissioner of income tax feels that there is any of these specified violations, then he can cancel the registration on occurrence of the specified violation. Number one, what is a specified violation? Where the income from the trust or income of the trust is applied for other than objects of the trust. So income of the trust is applied for other than the objects of the trust. The trust has business income, or I can write here PGBP, which is not incidental to objects of the trust, which is not incidental to the objects of the trust, or if income or if PGBP is incidental to the objects, what could be the next line that could lead to violation? Yes. If the PGBP is incidental to objects, what is the requirement to do? Yes. Separate books of accounts are not maintained. So if you have a PGBP incidental to objects, you are required to have a separate books of accounts, right? Income is applied for private religious purpose, or the income is applied for the benefit of particular religious community or caste. The activity carried out by trust is not genuine. Are not genuine or not in accordance with conditions of registration. The trust has not complied with the law. Or the application for registration is not complete or contains false information. Okay. So in that case, the principal commissioner on suo motu or on the basis of the reference received from the assessing officer during the assessment can cancel the registration or withdraw the registration which is given. It has the power. Okay. This is under section 12AB of the Income Tax Act. Are we clear? So the principal commissioner will call for the documents, verify, and then pass an order accordingly. Yes or no? Is this clear, students? Any questions? Any doubt? Fine. So this completes your charitable trust in entirety. If you have any questions, please do let me know. Now we are going to start with the taxation of the private trust. If you remember, I had told you that there are two type of the trust. One is the private trust and second one is the charitable trust. So now we'll start with the taxation of the private trust. Most of it you would have already done, but still we'll just consolidate everything over here. So private trust are of two kinds. Number one, revocable trust. Secondly, irrevocable trust. What is a revocable trust, students? You have already done that. Yes. What is a revocable trust? Yes, students, please faster. What is a revocable trust? You have already done. Which can revoke its activity? No, Ginny, that's not the answer. What is a revocable trust? Let me see who answers. Yes, nobody remembers what is a revocable trust? Section 63 of the Income Tax Act. What is revocable? It is defined under section 63, clubbing of income. Revocable if the transfer shall be deemed to be revocable if it contains any provision for the retransfer of the income or assets to the transferor. If the assets or income can be retransferred to the transferor, or it gives the transferor a right to assume the power over any of the income or assets that he has transferred. If the transferor has power over the income or assets transferred. So if the settlor has already transferred the assets to the trust, but these will be retransferred to the transferor, or if he has transferred the assets, but he still continues to hold the power over the income or the assets in the way he wants to utilize, then that kind of trust is considered as revocable trust. Meaning that the settlor has just given these assets to the trust, but he still has the power over the income or the assets in the way he wants to utilize it, or it will be taken by him back. Which means it is not going to be utilized for the beneficiary, it is going to be again utilized for the settlor. So in that case, section 61 says that the income would be taxed in the hands of, yes, income would be taxed in the hands of, income would be taxed in the hands of whom?
Ma'am, who transferred that asset?
Yes, in the hands of the transferor. Are we clear? So income will be taxable in the hands of the transferor. Clear? Next is under section 64, if you remember, the income arising from transfer of assets, which is otherwise then for adequate consideration, for the benefit of spouse, or for the benefit of the daughter-in-law. Do you remember this thing? Yes or no? Yes or no? Do you recollect 64? Yes? Yes, right. Correct. Yes, Mansha, right. So in that particular case, it will be considered as income of the, if the what? The income arises from directly or indirectly arises from the assets transferred otherwise than for adequate consideration, or assets transferred for inadequate consideration to the trust for the benefit of the spouse or the daughter-in-law. For benefit of spouse or daughter-in-law, then income will be taxable in the hands of, income will be clubbed in the hands of whom? Yes?
And transfer.
Yes. Income to be clubbed in the hands of the transferor. Section 64, 1, 7 and 8. Okay. So this is the concept of revocable trust, where the income will be taxable in the hands of transferor. Then what is an irrevocable trust? What is an irrevocable trust? Where the settlor does not assume any power. If the transferor does not derive any benefit directly or indirectly from the trust, or where the trust is not revocable during the lifetime of the beneficiary. Are we clear? So, section 62. Have you done this revocable trust or not? Irrevocable, revocable trust, have either you already done or are you doing it for the first time? Yes.
मैम ने डिटेल में नहीं कहा था, तो उन्होंने बोला था कि ट्रस्ट वाले चैप्टर में हम इसकी डिटेल में रीड करेंगे।
Okay. Transferor derives no direct or indirect benefit from the income, or the trust is not revocable during the lifetime of beneficiary. That is an irrevocable trust. Are we clear? So basically, if you see the trust structure, it appears something like this. This may be a trust. There may be a settler who transfers the asset to the trust, which is to be used for the beneficiary. So this asset is used for benefit of the beneficiary. And this trust is managed by a trustee. Okay, so if these assets which are transferred, if the settler has the power over those assets, right, then in that particular case, it is considered as the revocable trust. Or if these assets will go back to the settler, this is considered as revocable trust. If these assets are not giving any benefit to the transferor, to the settler, then this is an irrevocable trust. Now, when these assets are transferred to the trust by the settler, whether there will be any capital gain on this? Whether there will be any capital gain implication? Yes or no?
No, ma'am.
Why?
It is type of a donation.
No. Section 47. What is section 47? We have done that. What is section 47? Transactions not regarded as a transfer. So any transfer of a capital asset to an irrevocable trust is not considered as a taxable capital gain. So transfer of the capital asset to irrevocable trust will be exempt under 47. Whether 56 to 10 will be applicable in the hands of recipient? Yes. Whether 56 to 10 is applicable in the hands of recipient? No, Mansha. 56 to 10 is also not applicable if the beneficiary is relative of the settler. So in that case, 56 to 10 will also not be applicable. Are we clear, students? Yes or no? This is not a charitable trust. 56 to 10 exemption is only for a charitable trust. But here 56 to 10 will not apply if the beneficiary is a relative. Is this much clear or not, students? Yes or no? Yes or no? Why your energies are down in the new year? Yes. Yes. Okay. Now, again, under the irrevocable trust, there are different types of trust which are there. One is the specific trust. And the second one is the discretionary trust. The specific trust which are there are basically the trust where the shares of the beneficiaries are known. Where the shares of the beneficiaries are known. Now, if this specific trust has no business income, then the share of the beneficiary will be taxable in the hands of beneficiary at the slab rates. So, if no business income, then share of the beneficiary taxable in hands of beneficiary at the slab rate. And if they have the PGBP, then in that particular case, if it is a specific trust having the PGBP, then it will be taxable at the MMR. Okay? Will be taxable at MMR. The exception to this is trust is for benefit of relatives, in which case slab rate will be applicable. Okay. Now, if it is a discretionary trust meaning the shares of the beneficiaries are not known. Shares of the beneficiary are not known. So, if it is having no PGBP, then it will be taxable at MMR. Even if it has the PGBP, still it will be taxable at MMR. So then what is the difference? There are certain exceptions which make it different. Both has different exception. That's why I've made the two charts over here. If it has no PGBP, it will be taxable at MMR. The exceptions are basically in relation to the whether if there is any beneficiary which if there is no beneficiary having the other income other than the trust income which is greater than the basic exemption limit, or if the trust is declared under a will, or if the trust is for the employees, then in that case the MMR will not be applicable. The trust will be taxable like an AOP. The trust will be taxable like an AOP. So, no beneficiary has other income greater than the basic exemption limit and is beneficiary under only one trust. Trust is formed under will. Trust is employee provident fund trust to be taxed like AOP. How does the AOP get taxed when it has no business income? Yes. How does the AOP get taxed when it has no business income? Yes, students. Normal slab rate, Ginny? No. It's not taxed with normal slab rate. Yes, we have already done that. Yes, faster. Let's go back to the AOP class. So where the shares of the beneficiaries are unknown and no member has tax rate greater than MMR, the AOP will be taxed at the MMR. Right? So again, it will be taxed at MMR only. But the share of the member will be exempt under 86. Are we clear? So it will be taxed like an AOP. It will not be taxed like a trust, because if it is taxed like a trust, the income may be taxable in the hands of the beneficiary. But this will be taxed like an AOP at the MMR only. So the rate will remain the same, but it will be taxed like an AOP. For the second category, when the trust has the PGBP, in that particular case, it will be again taxed as the taxed at the MMR. But again, the exception are that the trust is created by will or for the benefit of relative or is the only trust of the settler. Trust for benefit of the relative or created under will or only trust of settler. In this case, this will be taxable at slab rates. This will be taxable at the slab rate. Are we clear? Any question, any doubt? Yes or no?
Ma'am, here relative is also same definition as we read earlier.
Yes, yes. So in case of the irrevocable trust, this will be taxed in the hands of trustee who will be considered as a representative assessee. What is a representative assessee? Representative assessee meaning is representing some other person, because trust is not a person. This income will be taxed in the hands of trustee. So trustee will file 2 income tax returns, one for his own income, one as a representative assessee for the trust. Clear? Yes or no? Any questions, any doubt? See, private trusts are basically created for the wealth planning, for the succession planning, when you want to pass your wealth down to the generations ahead. That's where these private trusts are basically used. Basically to, store the income outside India in the form of trust or within India and want to pass on the wealth to the beneficiaries. So that's where this private trust is used. Are we clear? Yes or no? Any questions so far? Yes,
Clear, ma'am.
clear. Why your energy levels are down, all of you? I mean, this is new year. You have to study now. In fact, your energy levels should be high and not low. So you have to keep on answering me. Otherwise, this will be, very monotonous. Last one, taxation of the income of political parties. Yes, political parties. So section 13A again grants the exemption from tax to political party. exempts the income of the political party. What are the exemptions which are given? Income from house property, IFOS, then capital gain, and the voluntary contributions which are received. So these category of income will be exempt provided the conditions are satisfied. What are the conditions? So it's a conditional exemption. What are the conditions? Number one, books of accounts are maintained. Secondly, the voluntary contribution records are maintained. Voluntary contribution records are maintained for contribution greater than rupees 20,000 with name of the contributor. Audit is done by a chartered accountant. No donation in cash greater than rupees 2,000 and return of income is filed. So if these conditions are satisfied, only then the income of the political party is considered as exempt. And similar is the case for the electoral trust also. Okay. Any questions, any doubt with respect to this entire trust concept? If you have any questions, please feel free to ask me because this is the end of this topic.
Ma'am, what is electronic test which you say in a last?
So electoral trust are basically, these again for the purpose of this voting and all, they use this electoral trust which are there. So that is where, this concept is used for. So this Election Commission of India, under that they work basically these kind of trust. So to collect the, donations during that time. So that is basically the electoral trust. So you see, the BJP receives these donations or these Congress receive these donations. So all of that basically come under electoral trust. Now again, that they also have these exemptions which are there. Okay. Similar to section 13 for the political parties, they have the 13B, which is applicable for the electoral trust. So these are set up basically with the objective to distribute the contributions received from the different companies and individuals to the political parties. So that is the electoral trust. No, it's not void completely, Mansha. People are still contributing and they have this still exemption which is there. Mansha, do not worry. You will surely clear. It's not, any time further. It's going to be this year for sure. But it's just that, keep your focus on. And I think, see, do not get disheartened with the fact that, any kind of, as I said about the past events. You have to just keep focus on the future, which will be, of course, better than the past, and keep your goals, keep your motivation high. It's you at the end who have to motivate yourself. Nobody will, come and pick you up. The motivation that, any external person will also give will be for a limited time, but that will fade away. It's just that, you have to strive to work better and better than what you have done in the past. I understand this exam is very difficult, not only at the level at which we are, preparing, but also could be emotionally exhausting also when we are unable to clear this exam. But trust me, you are not the only one. Do not look at the people who have only cleared and think that, okay, why my fate is like this. Do not think about those things. I mean, it's easier said than done. I understand the kind of emotional toll it takes. But at the same time, we have to keep ourselves motivated because that's the only gateway. But believe me, this becoming a CA is just the beginning of journey and not the end of it because you have a very bright future ahead. So just keep focusing any kind of distraction, any Instagram, social media, WhatsApp, please avoid it because that just takes your depression to the next level. Just stay away from it until you become your or achieve your goal and become chartered accountant. Fine. So with that, students, we'll move to the next topic, which is TDS, TCS, and advanced tax. Okay. So with respect to TDS, TCS, and advanced tax, now this is, a way of collecting the taxes, students. Okay. So it's not that, Section 4 says what? That the income of the previous year shall be charged or assessed to tax in the next following assessment year. Right? Now, how does the tax payment happens? So there are three ways. One is the deductor collects the tax or deducts the tax in the form of TDS or collects the tax in the form of TCS. All right. Second way is you pay your advance taxes, and the third is the self-assessment taxes. Now, this TDS mechanism, which is there, students, is not only availing in our country or prevailing in our country, it is worldwide. So, once, you qualify, you may be working in direct tax, international tax, you may not come across the word TDS. So when you speak to your clients who are non-residents, they will not understand what is TDS. They call this as the withholding taxes. So in other countries, they call this as the withholding taxes. And that's when I said that it's not, something only existing in our country, it's existing globally. So governments do levy the withholding taxes in order to collect the taxes because they feel that, the assessee may not himself pay the tax, may try to avoid the tax, may try to manipulate. And therefore, when we have this withholding tax or TDS, the tax deducted at source, we are able to kind of, put a brake on the tax avoidance. Because that reduces the opportunity for the taxpayer to not disclose the income because the tax is deducted, the return is filed, the government already has information. But unfortunately, students in our country, the system that has become at this point in time is that on every payment, they have started introducing the TDS, which has in fact resulted in a situation where we have become, or the payer has become, an agent for the government. See, at the end of the day, the government's job to collect the taxes or deduct or, recover the taxes from the assessee. But the government has started, unfortunately, shifting this responsibility on the payer and has started imposing the TDS obligations on each and every type of payment, making it an onerous thing. And if you do not comply with the TDS obligation, there are multifold repercussions. What are those repercussions? You will tell me. If a payer fails to deduct the TDS or deducts but does not deposit it with the government, what are the obligations? What are the repercussions?
Ma'am, there is penalty or fine also. And also, if there is a business, then that expenses are not allowed unless you pay TDS on that.
Correct. So there is 100% of the disallowance of expense if in case the payment is being made to a non-resident. In case the payment is to a resident, then in that particular case, the 30% of the expenditure gets disallowed, right? Then you have the payer being treated as assessee in default, right? The payer is treated as assessee in default, which means the interest will be charged at the rate of 1 and 1.5% under 201201A. Isn't it? So therefore, these are the repercussions which are there. Plus, if you do not file the TDS return on time, you are charged a late filing fee, right? Which is 200% per day. Plus, you have the penalties. Plus, you have the prosecution. So, if you see, there are so many repercussions on the payer if he fails to deduct the TDS or TCS, which is a very unfortunate way of collecting the taxes. But that's how it is. So section 190 of the Income Tax Act says that the taxes can be collected by way of TDS, TCS or advance taxes. Are we clear? Yes or no? So now
Yes,
we are
ma'am.
first going to see over the TDS. We are going to discuss couple of sections and then of course we will stop there and in the next class we will be continuing. So salary, the TDS on that is under which section? This is a very common section. Yes. Which is a section, students?
Section
192. Yes. It's very common one. 192. Yes, Mitali. So what 192 says? Let me just, read it from the act and show it to you the act only because again, we are going back towards the act. What does 192.1 says? Any person responsible for paying any income chargeable under the head salaries. So it says any person. Any person means what? What if a non-resident is making the payment of salaries to a resident employee? Or a non-resident is making the payment of salaries to another non-resident employee? Will 192 apply?
Ma'am,
Yes.
repeat the question.
The question is, if a non-resident employer makes a payment of salaries to another non-resident employee, will 192 be applicable?
No, ma'am.
Why no? It says any person. It doesn't say a resident individual or resident person. It doesn't say resident. It says any person. 192 will be applicable. Now your question would be, ma'am, if a non-resident employer is hiring a non-resident employee, why he will deduct the TDS in India? Right? That's an obvious question.
Yes, ma'am.
Correct? So for that, you will learn in international tax class, which says that a non-resident employee, if he comes and renders the services in India, so it is possible that a non-resident employer is hiring a non-resident employee. Let's say there is a US company which is hiring a US citizen for the purpose of, performing some task in India. It may have an Indian business, right? So that company may send the US employee to India for performing certain services or for catering to some Indian client. Then the portion of salary with respect to the services rendered in India will be taxable in India. You will learn that in section 912. So on that, the non-resident US company is required to deduct the TDS under 192. Are we clear? It says any person, right? So any person responsible for paying any income chargeable under the head salary shall at the time of payment. It says at the time of payment. It doesn't say at the time of credit or payment. Are you getting this word? So basically, if you see, the payer here is any person, which includes a resident or a non-resident. Payee is also any person. Time of deduction at the time of payment. Why, Mansha, status of payer payee is not relevant here? So it doesn't say at the time of credit. Only when the salary is actually discharged, is actually paid, not credited to my account, only then the TDS under 192 will be applicable. What is the rate of TDS? Deduct the income tax on the amount payable at the average rate of income tax computed on the basis of the rates in force for the financial year in which the payment is made on the estimated income of the assessee under this head for that financial year. So the rate of TDS is average rate of tax as per rates in force. Now, what is average rate of tax, students? Yes, what is average rate of tax? Basically, the slab rate. You will apply the slab rate, whatever the assessee chooses for, and then you will come to what is the average rate of tax, and that you will apply to your estimated income. It's nothing but the slab rate. Are we clear? Now, a question should come to you. How will the employer know which is the old regime or new regime you are opting for? So, see, students, the default regime is what? Which is the default regime?
New regime.
New regime. So 115 BAC is the default regime and that will be applicable. Now, if you want to opt out, you have to elect an option. But that you can only do when you file the income tax return, students. I'm not filing the income tax return in the year in which my salary is being paid to me. Are you getting this point? So how will the employer know? So the employee is required to make a declaration. The employee is required to make the declaration. He has to intimate to the employer that whether he's opting out of 115 BAC or he wants to continue with 115 BAC. In case the employee does not make an intimation, the employer shall deduct the tax as per 115 BAC because that is the default regime. Yes, Mansha, at the start of the previous year. So at the start of the previous year, the employee has to make an intimation to the employer. So here you can write the default regime is 115 BAC. The employee can opt out and intimate to employer. Otherwise, the default is 115 BAC. Now, if the employee says, while intimating to employer that I want to opt out of 115 BAC, that doesn't mean that the employee will have to go with that even in the return filing. Can the employee say in the return filing, no, I will go as per 115 BAC? Yes or no? He can. So, on the basis on which your TDS is deducted doesn't mean that even in the return filing, you will go as with the same regime. You can make the different election in the return filing. It is not that you are now having the stoppage that you cannot, go back to 115 BAC during return filing. Nothing like that. Or if you have gone with 115 BAC for your TDS, during the return filing, you can go to the old regime. Not a problem. So during the return filing, the employee can change the option. But yes, you cannot change the option now with the employer for TDS purpose. Because see, it will be difficult for the employer to recalculate every time. So now if you want to change it, you can do it at the time of filing the return. Are we clear? Yes or no?
Yes, ma'am. One question is there. Is non-resident is also need to file income tax return if he's
Non-resident,
yes, ma'am.
yes, he will have to file the income tax return.
Okay.
If he has an income in India, he will have to file the income tax return. Okay?
Yes,
Now
ma'am.
the employee will have to furnish the proofs for whatever exemptions that he's claiming. For example, HRA, leave travel concession, any other exemption, LIC, or for that matter, any deduction under ATC, whatever he's claiming, he has to give this information to the employer, and he has to also submit the proofs to the employer. Because otherwise, how will the employer come to know what is your salary income? He will know what is your salary. But whether you want to claim the HRA allowance, whether you want to, claim any kind of LIC deduction. So for that purpose, the employee is required to give the details in Form 12BB to the employer with respect to your name, address, or PAN of the landlord, leave travel concession if you are claiming, then evidence of the expenditure. If you are claiming the deduction with respect to the interest on house property, then you have to give the loan statement or name and address and PAN of the lender. If you are making any claim for medical expenditure, LIC, then you have to give the investment proof or expenditure proof so that the employer can verify and give you the benefit while calculating the TDS. Further, the employee can also inform the employer with respect to any other income that he has earned other than salary. He may be having interest income, he may have any sort of other income, and any TDS which is already deducted on that income, so that employer can take that also into account. Any loss that he has under the house property, if he wants to opt out of the 115 BAC, only then of course you can claim the loss under house property, right? If you do not have a rental property, if you have a self-occupied property, you can claim the interest only when you opt out of 115 BAC. Yes or no? Right? So you can give this information to the employer. And the employer can consider that and then calculate the TDS. If you have changed the employer during the year, then also you need to intimate your new employer that this was my salary in my previous employment. Otherwise, see what happens. The most of the clients that we get will come and say, oh, why you are asking us to pay an additional tax? Because they have not reported their salary to new employer of the old employer. And what happens is both the employer consider the slab of 2.5 lakh, resulting in the slab of 5 lakh, whereas it should be considered as 2.5 lakh only once. Because you have not reported your income to the other employer, he has not considered that income, resulting in the slab rate being calculated twice. Right? So at the end of the year, when you come and file the income tax return, you will have to end up paying more taxes. More taxes means if you have defaulted on taxes, you will have to pay interest under 234 BC also. Isn't it? So you have to report to your new employer whatever is the income from the old employer as well. Clear till now? Yes or no? Yes?
Yes, ma'am. Ma'am,
Okay.
if I employer deduct the TDS and not deposit to government, so what is the penalty for that?
So penalties, see, you will have to, there are separate penalties, not only for employer perspective, but it is for all the payers who are there. So we'll come to the penalties part at the end of the, TDS. There are penalties which are in the monetary term. There is also prosecutions as well. But it is not only for employer, it is for every payer who is failing to deduct and or failing to deposit with the government. Are we clear?
Yes, ma'am.
Okay. Now 1B says that without prejudice to the provisions contained in subsection 1, the person responsible for paying any income in the nature of perquisite, which is not provided for by way of a monetary payment, which means a non-monetary perquisite. What are the examples of non-monetary perquisite? What are non-monetary perquisite, students? Yes, Mansha, RFA. What others can be the non-monetary perquisite? You're giving the chauffeur-driven cars, right? You're giving the houses on accommodation for accommodation. You are giving the houses with furniture. There are so many example vouchers, so many example of non-monetary perquisite, right? IPCC. So when the employer gives the non-monetary perquisite, how does he deduct the TDS? How does he deduct the TDS? So in that case, 1A says, 192 1A says that the employer can pay from his own account without making any deduction, because it's a non-monetary perk. You are not paying any monetary consideration. So the employer can pay on his own account without making any deduction to the employee. So that option is given to the employer. Are we clear?
Ma'am, that will not included while calculating the TDS. You say that?
No, that will not be included in TDS as such. That means is that this tax is paid by the employer as the TDS only, but it is not deducted from that perquisite because you cannot deduct. So you will pay from your own pocket. And that again is considered as the non-monetary perquisite in the hands of employee. So when the employer pays the tax obligation, which is basically the obligation of the employee. So again, that tax, if it is paid by employer, it is considered as a non-monetary perquisite only for the employee. Are you getting this? So
Yes.
what will happen is, see, there will be a circular effect. See, rupees 100, let's say I'm giving you a car worth rupees, let's say 100, a hypothetical example. Let's say on that 100, the tax comes to, let's say hypothetically 10. Now this 10 will also be considered as your perquisite. So your perquisite becomes what? 110. So again on 110, you will calculate tax. So again down that 110, the tax will again go as your perquisite. So there's a circular way which is getting formed. So to avoid that, what we do is we do a kind of grossing up. We do a grossing up of tax. So 100 into 10 divided by 100, that's what we will do. So we will do a grossing up kind of situation. Divide by, 110. So that will be a kind of grossing up with which you come to a final figure of what is the tax liability. But that tax amount is considered as the income of the employee as a non-monetary perquisite. Are we clear?
Yes, ma'am.
Under PGBP, if you remember, there is a disallowance of the expenditure of such tax paid by the employer for the employee on the non-monetary perquisite. Do you remember? Under PGBP, this tax amount is disallowed as expenditure for the employer. Under which section? Do you remember?
Yes, ma'am. 40A5, I think.
Yes, very good. So under 40, if I say this is how it should strike in your mind. Let me just show you 40A5. So if you see here, where is 40A5? Yes. Any tax actually paid by an employer referred to in clause 10cc of section 10 is not allowed to you as the expenditure. Are we clear? So therefore, any kind of the tax that you are paying for the employee on the non-monetary perquisite will be considered as the disallowed expenditure. Are we clear? Are we clear? Yes. And this then tax amount will be considered as exempt in the hands of employer because I'm disallowing the expenditure for the employer. This amount means it is getting taxed in the hands of employer. By disallowing the expenditure, I'm in fact taxing that expense, right? So this expenditure will be, sorry, this tax amount will be exempt in the hands of employee under 10cc. So ideally what I said is this tax amount is considered as the non-monetary perquisite for employee, but then it will get exempt under 10cc. Are we clear about this? See, from 192, I'm taking you back to exemptions and to the PGBP. Yes or no? Clear? Yes or no? Clear or not?
Yes, ma'am, clear.
Okay. Now, what does 1C say? For the purpose of deducting the tax or paying the tax under 1 or 1A, a person being an eligible startup, which is referred to in 80 IAC. So, eligible startup referred to in 80 IAC, if it issues the ESOPs, then in that particular case, so it says the perquisite in the nature of 1726, which is nothing but the ESOPs, then it has been given an extended time to pay or deduct the tax. What is the extended time which is given? Within 14 days after the expiry of 48 months from the end of the relevant assessment year, or from the date of sale of those ESOPs by the employee or assessee, or from the date of the assessee ceasing to be the employee, whichever is earlier. So generally when the ESOPs are given to you, right? Generally when the ESOPs are given to you, the ESOPs are taxable as a perquisite when you exercise the ESOPs under 1726, right? At the difference between the fair market value and the exercise price is considered as your perquisite. So obviously, if it is considered as perquisite, the employer will deduct the TDS. But this was causing the difficulties for the startups, right? Because for the startups, it takes a lot of time for the employees to earn the remuneration on those ESOPs, for the ESOPs to grow. It's a startup. For a normal company, the ESOPs will generate the value like this. But for startup, it may take time to generate the value. So therefore, they have given an extended period. So they say 14 days from the expiry of 48 months from the end of the relevant assessment year in which ESOPs are exercised. So they are giving a almost 4 years time to you, isn't it? Or when you first sell these ESOPs, or when you leave the employment. So any of the earliest event, 14 days from that, the employer will deduct the TDS. Are we clear? Yes or no? Any questions, any doubts so far? Okay. Yes. Fine. Okay. So this is about your section 192. So here the employer has to deduct the TDS. Now, one question or one case law that I want to discuss before we close the session is basically concerning what about the tips that the customers give in the hotel or in the restaurant. When you go and eat, you generally give the tips to the waiters. But instead of giving it to the waiters, you add to the bill amount. Generally these days when we make payments from Zomato, Swiggy, Dine Out, you add the tip amount and this amount will directly go to the employer and not to the waiter. So earlier it used to happen that, the waiters used to come and then, used to keep the tip in the folder that with the bill that they bring, and they will only used to take it. Or, they used to ask you the tip de do, and you used to just pay them. But nowadays what happens is when you make the payment through these Zomatos because of the offer that you have, the tip gets added to the bill amount and then it's paid to the employer, and then the employer will pay to the waiters. So whether the TDS is required to be deducted on those tips, that was the question before the Supreme Court in the ITC case. This case is there in your module also, okay? So the Supreme Court said that giving these tips is not a part of the employment contract. I'm not as an employer, I'm not obligated to pay you the tips. There is no predefined sum that I have to pay you month on month as a salary, right? So therefore these tips are not arising out of the employment income. These are voluntarily paid by the customer to me, and I am holding these tips as an employer in the fiduciary capacity for my employee, in the trust that I will pay to my employees. These are voluntary amounts. Some may give 50, some may give 100, some may give 500 also. So there is no employer-employment relationship on these tips. And these are not regarded as profits in lieu of salary. So therefore, there is no liability to deduct the TDS on these amounts. Clear? Yes. So with this, I think we can just stop. If you have any questions, I can take it. Otherwise, we can continue in the next class. Any questions, any doubts that you have? No questions? Is this clear? All of you?
Ma'am, can I discuss a case with you regarding this?
Yes, please.
Ma'am, one of our client come and he said that his employee after 2 years deduct a TDS related to 2 year back salary,
Okay.
and now he deposited after 2 years.
Hmm.
So ultimate he increased the salary that day, and now the government asked for interest and penalty to employee also. So how it will handle?
See, the is it the case that he has been paid some arrears?
No, ma'am.
So why then additional salary has been paid to him?
Ma'am, not additional salary. Actually, in a calculation that year, employer make a mistake.
I see. Okay.
In that year, employer show lesser salary, but
Hmm.
after 2 year, it increase the salary of all employees.
Okay, got it. So, see, if the salary amount was originally correct, then of course the employee can, file an appeal and say that, I've not been paid this much salary, and therefore, I should not be liable for any interest. It's just the error that has been committed by employer, and the best way is to sort out that dispute with the employer. But in case it cannot be, because if the companies are usually big, they will not entertain you after many years. So, best way is to go for appeal. In case the salary has been revised to a correct amount, then of course, yes, the employee in fact has not disclosed the salary at that point in time. He has made a short declaration. So yes, he will be liable for interest and penalties.
Ma'am, employee is already give tax according to correct, original salary,
But was
right?
it correct amount or was more received to him?
Ma'am, on the correct salary.
Okay, then
But
of course
now,
he can file an appeal.
now employee whatever TDS pay is charged from these employees itself. मीन्स अभी जो टीडीएस है वो इस साल दिख रहा है, शो हो रहा है, लेकिन जब उन्होंने वो टीडीएस रिटर्न फाइल की थी उस टाइम पे वो नहीं मिल रहा था उन्हें टीडीएस, तो उन्होंने एक्स्ट्रा पेमेंट कर दिया, तो 25,000 का जो डिफरेंस आ रहा है, और जो टीडीएस पे सैलरी पे टीडीएस कटता है उसे हम बाद में वो भी नहीं कर पाते ना,
Correct.
ले नहीं पाते, तो उस केस में क्या कर सकते हैं हम?
See, I would say that if the TDS is reflecting in this year, just claim the TDS as is. I understand that this would be, not matching with your income. But in case if it is reflecting in your 26 years, just claim it for this year. Even though you have paid it for the earlier year already, you cannot now, revise the earlier year return. So just claim it for this year. In case there is interest or penalty raised, then of course you can, file an appeal with respect to that.
Okay, thank you, ma'am.
Yeah. Any other questions, students? Okay, so that's it. So thank you so much, students. Please revise. And as I said that, just start this year afresh. Start revising, start maintaining notes. Now it's January. You have exams in May. So you're already now left with 4 months. This is sufficient time. It's not that you are short on time, but having said that, you need to put at least 14, 16 hours for studies. But that doesn't mean you sacrifice on your health, your sleep. Sleep may be sacrificed, I'm very sure about it, but at least do not sacrifice on your health. Please do not, do something that may cause, health concerns, because again, that will affect your studies only. Do not take so much of pressure that your health suffers. Keep your sanity. Have faith in God. It's everybody will have their own pace of time to clear the examination. There is no race that we are running that who passes first. Your friends may have cleared. Please do not think about that. Just shut out yourself from the external world and just focus on this one goal very clearly. And as I said, start making your notes from year onwards, because that will help you consolidating on the last year of the exam. That will help you revising everything within that one day that you get. So just stay focused. And as I said that please maintain also a focus on your health so that you do not fall ill. Okay. Thank you so much and see you in the next class. And we will start again with the TDS topic. Thank you so much. Ginny, when I understand, see, but as I said, just be done away with your past. Whatever has happened in the past, do not get bogged down by that. I understand it's very difficult. You may have that fear. What if you are not clearing again? But see, take these exams as a test. Okay. See, these are very different exams compared to what exams that we have given so far. We are going to be qualified as a professional who is, ready to certify the financials of companies. So it requires that level of, professional approach to handle these examinations. So as I said, the way we have grown so far, we have been, securing ranks, good results at 12th or graduation level. But this exam is very different, very, very different. You may be a ranker in any of the other exam, but this is very different because it requires you a different level of understanding. See, CA exams require you to practically understand the CA curriculum which is there. Only then you will be able to answer. Because it's not that, the way we used to give our graduation exams, the exams are not in a similar manner. So consider this as test. Do not think that if you're not clearing, you're not knowing any better. That is not the case. There are people who have cleared in first attempt and have not been able to, flourish in their practical life. So do not think that this is your end of it. You are already knowing, but you need to put more efforts to clear these exams. That's the end of it. That's it. You don't need to think about past. Whatever happened in the past has gone by. Focus on the coming exam. Do not get depressed. Do not even let depression touch you. Okay? Thank you so much. Any other questions? Okay. So thank you so much, students. See you in the next class.
Thank you, ma'am.
Thank you. Yes.
Thank